Welcome back to America's Commercial Real Estate Show. I'm Michael Bull. And this segment is brought to you by GetValuate.com. Check it out. It's pretty awesome online software to do investment analysis. It's GetValuate.com. Well, today we're talking about the Trump effect on the economy and commercial real estate, or we could call it the impact from the Tax Act, the Jobs Act. So it's been amazing, the things that have been going on: repatriation, reduced tax rates. You know, we've seen significant changes in the tax rates and the things that affect our economy in the U.S. And we've been in this cycle, this great cycle, for such a long time. What are we, 9 years now? So what is the impact of all this on our commercial real estate decisions moving forward? Please welcome my guest, Adam Kamins. He is senior economist with Moody's Analytics, and he's joining us on the phone. Adam, thanks for being with us.
Thank you, Michael.
Well, let's look at this, Adam, from just a generic outlook. Is real estate and commercial real estate a winner in all this?
Absolutely. So if you think about kind of the overall impacts, there are some clear winners and losers. And the way the final bill came to pass, commercial real estate really came out with a number of benefits in terms of the reduction in the corporate tax rate, the maintenance of the 1031 exchanges, for example. All of that is very favorable to commercial real estate. You also have some specific effects where, for example, the residential market actually gets hurt a little bit by the fact that property tax deductions are now capped, that the mortgage interest deduction is no longer as generous. That actually is going to help the multifamily market. And you kind of put all of that together, and commercial real estate really does benefit probably as much as sort of any aspect of the economy.
Okay, and you mentioned multifamily, and that makes sense. If some of the benefits of owning a home are gone, maybe it pushes a few more people to rent versus purchase. And you mentioned the reduced tax rates for corporations, which it seems like it's very significant. What does that mean for the jobs market, you think, moving forward? Adam, are we going to have even more jobs and more growth, and is that really good for the office market?
Well, it's sort of an interesting dynamic right now for the office market, especially because the economy is in very strong position even before this bill was passed. So we're already probably either at or even beyond full employment. This is going to give a little extra juice to the economy, but it's actually fairly unusual for a stimulus like this for the broader economy to kind of take hold when you're already at full employment. So what it means is that there aren't as many workers out there as there would be during the time where you would traditionally see this sort of stimulus and this kind of reduction potentially in tax rates and more money going into companies' pockets. So I would expect that there'll be a little bit of a pickup in overall hiring. There's going to be a little bit more demand, at least over the next year or two, for jobs. But where I think you're really going to see an impact is there's going to be even more pronounced upward pressure on wages. As companies really work to find employees, that's going to make it harder and harder to find kind of the appropriately skilled workers that you need, and it's going to create actually kind of additional upward pressure on wages and some inflationary pressures as well.
Wow, that's a very good point, Adam. And then when you think about that, and you look at apartments in particular, wow, that's fantastic, especially if there's a lot of construction jobs created from the infrastructure investment, right?
That's right. Although what I worry about with construction there is that there are already a number of markets, a lot of the U.S. where it's hard to find construction workers right now. And you're seeing this a lot in the apartment market in some faster growing parts of the country, especially kind of the South and the West, where residents are being added. The apartment market has been on fire for most of this cycle. It's actually kind of the fact that there's going to be potentially kind of even more demand overall in the economy because you have this stimulus effect. That's going to create even more demand for construction workers. They're going to be even harder to find. It's going to create probably more upward pressure on wages in construction as well. We actually, interestingly, have not seen that much in terms of wage growth for construction, even though it's been hard to find workers. I think that will probably start to course correct now. There's going to be kind of no choice but to give workers wages, kind of higher wages as a result.
Yeah, I mean, it makes sense if we have even more job growth. We already have a healthy job market, if there's more job growth from these corporate tax reductions, then maybe we'll see some. I guess the employees around the country are clapping, doing the Snoopy dance right now. So what does that mean for retail? I mean, if the employees maybe have reduced tax rates and they have maybe potential hikes in their income, is retail a beneficiary?
Retail, in the short run, probably is a little bit of a beneficiary. Again, this depends a lot on which part of the country we're talking about. So in states where state and local taxes and property taxes are not all that high to begin with, where the elimination of the state and local tax, the SALT deduction, or not the elimination, but the cap on the SALT deduction isn't as impactful, then consumers are probably going to have noticeably more money in their pockets, at least in the short run. They'll spend a little bit more. That should give a little bit of a jolt to retail. On the other hand, if you look at markets like New York, New Jersey, Connecticut, California, places where tax rates are high and some of the offset that existed in the tax code is no longer going to be as generous. In places like those, I would actually expect that the benefits to retail are going to be a lot more limited in the short run.
That's interesting. So there really are some winners and losers regionally, right?
Yes, absolutely. I think some of the higher tax states that I mentioned, places with high tax rates, high property values in particular. So again, this is where New York, New Jersey, Connecticut are actually among the three states in the models that we run. Those are the three that look like they benefit the least, and in some cases actually are hurt on net by the law. Whereas in other parts of the country, we look at a lot of the South. Alabama, actually, I think among all states, the one when we run it through our simulations, that looks like the one that benefits the most. But you also have regions of the country like the Mountain West and other parts of the South states like Tennessee, the Carolinas. They do pretty well as well.
Yeah, we're talking with Adam Kamins, senior economist with Moody's Analytics, and so. Adam, what does all this mean for interest rate changes? I mean, I think we've been expecting interest rate hikes for years. They haven't come. Seems like now they're a little more on the table. What do you guys expect moving forward?
We expect that they're coming now. For a while, we've been waiting to see the Fed raise rates a bit more aggressively, but the inflation pressures in the economy just haven't really been there to compel the Fed to do it. That's going to change now. We expected that even absent the new law, that some of these increased wages and some of the other dynamics that we've talked about that had an effect on retail and on consumer confidence, those probably would be taking hold anyway. This is going to kind of turbocharge that, and it's going to put a lot of pressure on the Fed to raise rates more quickly than some investors are likely expecting. We've actually already seen early this year a lot of volatility on Wall Street, and a lot of that is sort of probably adapting expectations now to the fact that monetary policy is going to be a bit more hawkish over the next couple of years. So I would expect that we're going to see rates move kind of steadily higher. Our initial expectation is something along the lines of 1 quarter point increase each quarter over the next couple of years, and that actually is going to offset quite a bit of the benefit of the new tax law. It's going to some of the benefit in terms of more money flowing into the economy, the overall fiscal stimulus, is going to be offset by the fact that rates will be higher.
Yeah, it's interesting to contemplate interest rates in 24 months possibly being 200 basis points higher. How do you think that impacts real estate cap rates or values?
I think it has an impact for sure. I think cap rates have been, they were falling for most of this cycle. They kind of had been. We've seen it start to steady already. I think the fact that the kind of underlying rates or the underlying kind of rate environment is going to grow higher. That means that there's going to be even more kind of upward pressure on cap rates. So I'd expect to see a pickup in cap rates over the next couple of years. I think prices will probably be affected, maybe not immediately, but I think price growth, what we're likely going to get is probably for the next year or two kind of a pickup, kind of a reacceleration of price growth because of the short-term stimulus. But what I would then expect would be by the time we get to about 2020, 2021, where some of that, kind of the sugar high of this tax reform bill passes, you're probably going to get a bit of a correction. And I mean, this actually reflects what we expect to see in the broader overall economy, that we're going to get kind of a much more cyclical economy now, that we're going to get more growth in 2018 and 2019, but kind of a more noticeable slowdown in 2020, 21, and probably higher recession risks early next decade. And I think that will be seen in terms of commercial real estate prices, and especially in terms of overall deal volume, I think.
Okay, and what did it do to your idea, Adam, of the length of the cycle? We've had good times for 9 years. Now you look at things that have happened in the last, 6 or 8 months. Has that extended the length of this cycle to you?
What it's done is it's taken where we are in the cycle currently, which is moving into the later stages of the business cycle. And it's going to make the economy over the next year or so look like one that's probably more kind of in the middle of the cycle. But that's going to be a temporary effect. I think actually, if anything, this may shorten the cycle a little bit, because what ends an expansion is the formation of imbalances in the economy. And the fact that you're going to get kind of a pickup in wage growth, a pickup in property prices, you actually create a little bit more of a risk of overheating in the economy. And that's when you can start to see some bubbles form. So I would actually expect that it's going to give a little bit more short-term juice, but it may, if anything, shorten the cycle a little bit.
Yeah, well, that's interesting. I was talking to a client of ours that is a young man, and he's only been through one down cycle, and that was 09. And I was telling him that I didn't expect the next recession to be quite as severe, or near severe really, is what I told him, than the past one. What do you think moving forward?
Yeah, let's hope you're right about that. I think the Great Recession was, it was the worst recession since the Great Depression, and I think people's memories of, and expectations sometimes tend to be colored by the last thing they experienced. So when people think recession, and I'm guilty of this too sometimes, you sort of flash back to 07, 08, 09. Our expectation is that the next recession, in all likelihood, will be more of kind of, a run-of-the-mill, in quotes, recession, where we don't expect that we're going to see, the kind of, housing bubble collapse and financial market, kind of meltdown that we saw in 07 and 08. But again, it's very hard to predict more than about 6 to 12 months out what will be the underlying cause of that next recession. But right now, when we look around in the economy, we don't see anything that's sort of, concerning enough and large enough to affect the economy. There are some sort of isolated bubbles out there. I think cryptocurrency, Bitcoin would be one that kind of jumps to mind. But these are relatively small, isolated bubbles that wouldn't bring down the entire economy the way the housing market did last time.
Yeah, good point. Well, we're going to take a short break. When we get back, I want to ask Adam about his ideas, his thoughts, or maybe tips or strategies moving forward related to the use of commercial real estate or commercial real estate investment or financing your properties, because hey, we want to skate where the puck is going, right? So stay with us. I'm Michael Bull. This is America's Commercial Real Estate Show.